We continue in Module 4 by comparing a couple of the more popular flow-through entities, partnerships and S-corporations. Welcome to video T12B. Let's start with a quick comparison of S-corps and partnerships. First, S-corps typically have higher organizational costs and higher compliance costs. State fees, filing fees, setup fees, many times these are more expensive for an S-corp than a partnership. In addition, a few states have an S-corp tax that does in fact tax income at the S-corp level. Ownership rights are far more flexible with a partnership than an S-corp. A partnership agreement can spell out how income, deductions, gains, and losses can be allocated to different partners. S-corps are required to allocate income based on pro rata ownership, period. This can be both a curse and a blessing. If the owners simply want the income items to be split pro rata anyway, then the S-corp is easily understood. Partnership agreements can be customized, and thus customization can be complex. In general, the tax law surrounding S-corps is easier than partnership tax law. Because S-corps have more predictable ownership rights, the tax law can deal with it more easily. Partnership income is subject to self-employment tax, whether distributed through guaranteed payments or income allocation. S-corp owners pay employment taxes only on the wages paid by the S-corp, and the remaining income allocation is treated as ordinary income, but is not subject to the self-employment tax. Protection from liability is obviously a big deal in a country as litigious as the U.S. With an S-corp or a limited liability company, the owner's liability is generally limited to their investment. For example, Bob and Betty organize an S-corp by investing $10,000 of cash each. Shortly after the organization, the S-corporation borrows $100,000 to buy an apartment building. The rents for the apartments do not materialize, and the bank can foreclose on the building and demand that the S-corp pay over any cash held by the S-corp to cover the mortgage. Bob and Betty lose their $10,000 investments. If Bob and Betty organize this as a partnership, to the extent the building and cash do not cover the debt, the bank can pursue against Bob and Betty personally for the remaining balance. That is some of the significant differences between a partnership and an S-corp. We lightly touched on LLCs, and we'll visit all of these entities again in future videos. Thanks for watching video T12B.